California is drafting a suicide note to its own economy. And it starts with a tax bill that demands money people don't actually have.
It really does sound like hyperbole, doesn't it? But when you actually run the math on this thing, I mean, suicide note might be too polite.
Yeah, it's more like an eviction notice.
It's an eviction notice
Hey,
for
Jen.
the entire tech industry. Yeah.
And we aren't talking about, some standard tax hike here. We're talking about a scramble, a literal panic. Just picture the scene. It's late December. You're at Art Basel in Miami. Weather's perfect. You're looking at some, overpriced art, maybe holding a cocktail. The whole vibe is relaxed.
Until the phones start ringing.
Exactly.
Huh?
And they all started ringing at once. This isn't a hypothetical. This actually happened. High-end real estate brokers, guys like Julian Johnston, they describe this moment as a tipping point.
He literally watched a panic sweep through his billionaire clients in real time.
All because a piece of legislation in California Assembly Bill 259, it stopped being a rumor and it started looking like a reality.
And that led to what everyone's calling the 7-day scramble.
7 days to uproot your entire financial life. I mean, we're talking about people flying into Florida, buying properties sight unseen.
Closing deals in under a week?
Yes, just to establish residency before that January 1st deadline.
It sounds so dramatic, but when you look at the text of AB 259, the Billionaire Tax Act, you get it. You get the panic. And that's what we're deep diving into today, not just the politics of it, but the mechanics. Because the math in this bill is, well, it's unprecedented.
It is a fascinating and, frankly, terrifying case study.
Yeah.
We've pulled the bill, text analysis from the Tax Foundation, Fox Business reports, legal commentary, all to figure out why this thing is being called a suicide note.
And headline, it's pretty simple. California wants a 5% annual tax on your worldwide net worth if you have over $1 billion in assets.
Which, on the surface, that sounds like the usual fair share talk we hear every election cycle. But the devil is always in the definitions, isn't it?
Always. Especially how they define wealth and how they value it.
Exactly. And that's the core problem here. And the reason people are literally fleeing the state, this concept of unrealized gains.
Right. We hear that term thrown around all the time, but in this legal context, it means the government is taxing money that doesn't exist yet in cash form.
Let's use a simple analogy, just to strip away the jargon.
Okay, sure. Let's say you have a rare baseball card collection. You bought some card for, I don't know, $10 in 1990. Today, a price guide says it's worth $1 million.
Okay, great. I made a great investment, but I still just have the piece of cardboard. I haven't sold it. I have $0 in the bank from it.
Exactly. You are paper rich, but cash poor. Under this new bill, AB 259, California sends you a tax bill for $50,000.
Which is 5% of that million.
Payable immediately.
And since I don't have 50 grand just lying around, I have to sell the card to pay the tax.
You're forced to sell it. Precisely. Now just scale that up. Instead of a baseball card, it's a founder's equity in the company they built from scratch.
And this is where that Scrooge McDuck fallacy comes in, right? I think people assume billionaires just have swimming pools full of gold coins.
Yeah, that's a common image.
But for a tech founder, like 99% of that wealth is just stock. It's all paper. It's betting chips on the table. It's not cash in a vault.
Correct. And that creates this huge liquidity crisis. Your stock goes up, you suddenly owe billions in cash. If you don't have the cash, you have to sell the stock. But if you force every billionaire in the state to sell huge amounts of stock at the same time,
You completely tank the stock price.
which hurts the company, it hurts the employees, it hurts every pension fund that's invested in that company, it becomes a death spiral.
But here's the kicker. The part I found really sticky in the bill text. It's the Hotel California clause. You can't just leave.
The exit tax. Yeah, this is crucial for understanding why people are moving now. If you were a resident on January 1st, 2026, you are on the hook, period.
Even if you move to Texas in February.
Doesn't matter. The tax literally follows you.
So it's a clawback.
It's a golden handcuff. Or maybe more like an iron shackle. It phases out over 4 years. You pay 100% the first year you're gone, then 75% and so on.
Which explains the Miami panic. You had to be gone before the clock struck midnight on New Year's Eve. If you wait until January 2nd, you've just signed a check for hundreds of millions of dollars to a state you don't even live in anymore.
Exactly. But honestly, that residency trap is just the appetizer. The main course, the part of the analysis that it actually shocked me, is what the Tax Foundation found about voting rights.
All this, the corporate killer provision. This is where the bill goes from, I guess, aggressive taxation
Yeah.
to something that looks a lot like forced expropriation.
That's a strong word, but when you see the math, it fits.
Let's walk through the Tony Zhu example because I had to reread this 3 times. Tony Zhu, the CEO of DoorDash.
Right. So this whole thing hinges on how Silicon Valley companies are structured. Founders often hold what are called Class B shares.
Super voting shares.
Super voting shares, they give you control over the company's direction, even if you don't own a majority of the financial equity. It's about being the captain of the ship.
Right. It's how Zuckerberg runs Meta, how the Google founders stayed in charge. It protects the original vision from, Wall Street raiders.
Precisely. So Tony Zhu owns about 2.6% of DoorDash's economic value. He's rich, obviously, but he doesn't own the company. However, because of those Class B shares, he controls 57.6% of the vote.
Okay, so he's the boss. He steers the ship.
Now, here's the trap in AB 259. The bill allows the state to value your stake based on your voting control, not your financial ownership.
Wait, what? They can tax him as if he owns 57.6% of the company's financial value.
That's what it says.
But he doesn't have access to 57% of the cash or stock. He just has the votes.
Doesn't matter to the California Tax Board. The Tax Foundation ran the numbers. Based on this valuation method, Tony Zhu's tax liability for a single year would be about $2.62 billion.
Okay, and his actual stock is worth what?
About $2.41 billion.
So his tax bill is higher than his entire net worth.
It's an effective tax rate of 173%.
That's impossible. You'd have to sell 100% of your assets, everything you own, and you would still owe the state $200 million. You'd be bankrupt.
And that leads to the only possible outcome: forced liquidation. To pay even a fraction of that insane bill, ex-UN founders like him would have to sell those super voting shares.
Which means they lose control of their company.
Instantly. It strips the founders of their voting power and forces those shares onto the open market. It's effectively a government-mandated corporate takeover. You're forcing the people who built the company to sell their control just to pay a tax on wealth they can't even touch.
That feels like the real headline here, It's not just about paying your fair share. It's about who controls the primary engines of the American tech economy. If this passes, Silicon Valley as we know it is just over.
It becomes owned by hedge funds and asset managers. The visionaries get cashed out and kicked to the curb.
And that's just for public companies where you can see the price on a screen. I imagine it gets even worse for private businesses, right? Like a big construction firm or a startup that hasn't gone public.
Oh, this is where it gets really bureaucratic and ugly. Since there's no market price, the state uses this blunt instrument to guess your business's worth. The formula is book value plus 7.5 times annual profits.
That sounds incredibly arbitrary. I mean, a grocery store isn't valued the same way as a software company.
It is arbitrary. And it gets worse.
Yeah.
The formula completely ignores debt. And it ignores losses.
Wait, hold on. It ignores losses.
Completely. If your business loses money 1 year, which happens all the time in startups or construction, the state just treats your profit as zero. They don't let you count the loss. They just pretend the bad year didn't happen and tax you on your assets anyway.
Heads I win, tails you lose.
And if you try to fight it, let's say you hire an independent appraiser who says, actually, California, my business is worth half of what your formula says.
Which seems like a reasonable thing to do. That's why appraisers exist.
It's a dangerous dispute under this bill. The text includes penalties for the appraiser. If the state decides your appraiser undervalued the company, they can fine the appraiser personally for millions of dollars.
That is chilling. That sounds like intimidation. If I'm an appraiser, I'm never going to risk a low valuation. I'm just going to inflate everything to protect myself.
Exactly. It destroys the whole concept of an honest, independent valuation. It creates the systemic incentive to overvalue everything, which just inflates the tax bill even more.
So given all that, the 173% tax rates, the valuation traps, this Exodus narrative isn't just media hype then.
Oh, it's absolutely real. Look at the names on the moving trucks. Larry Page, co-founder of Google, the ultimate California success story. He's moved his businesses to Delaware and he's scrubbing his California residency.
When the guy who founded Google decides California is bad for business, you have a major problem.
Peter Thiel's gone to Miami. David Sachs has gone to Austin.
And David Sachs didn't mince words. He called this bill tyranny. He called it asset seizure. He sees it not as a tax, but as the government just confiscating private property.
Now, to be fair, you will hear a counter-argument. Jensen Huang, the CEO of NVIDIA, he was asked about this and he basically shrugged and said, so be it.
Yeah, I saw that. It kind of threw a wrench in the everyone is leaving story.
But you need the context. Jensen Huang doesn't have that dual-class share structure we talked about. He owns about 3.8% of NVIDIA, and he controls 3.8% of the vote. He isn't facing that nightmare 173% tax rate. He's the exception, not the rule.
So the bill hits different billionaires in completely different ways.
Exactly. But the peer effect is real. That broker, Julian Johnston, talked about this. These guys operate in networks, VCs, founders. They move in herds. If Peter Thiel and the PayPal mafia move to Miami, the whole ecosystem starts to move with them.
Which brings us to the Laffer curve argument.
Right. The economic principle that politicians always seem to ignore. It basically says if you tax something too much, you eventually get less revenue because the activity just, it stops.
Yeah.
Or it leaves.
And California is uniquely vulnerable here because of how top-heavy its tax base is, right?
Incredibly so. The top 1% of earners pay roughly half of California's entire income tax revenue.
Half.
Half. The whole state budget. So if you chase away even, say, 50 billionaires, you aren't just losing the new wealth tax. You're losing all the income tax they were already paying.
And that's a real risk.
It's not just a risk. The state's own budget researchers, the Legislative Analyst's Office, they warned about this. They said the potential loss in income tax from people fleeing could actually outweigh the gains from the new wealth tax.
So the state could end up with less money than it started with. It's the classic killing the golden goose scenario.
It is. You kill the goose to get all the eggs, and you realize there are no eggs, and now you just have a dead goose.
But let me play devil's advocate for a second. For the person sitting in traffic on the 405 right now, who might be thinking, good riddance. I don't care if a guy with a private jet moves to Austin. How does this actually hurt me?
That is the Trojan horse problem, and it's why everyone needs to be paying attention. You have to ask the question, will they stop at billionaires?
History would say no.
History says absolutely not. Look at France. They tried a wealth tax. It didn't just hit billionaires, it hit millionaires too.
And what happened there?
Economic carnage. 60,000 millionaires left the country. 60,000. It caused such a massive brain drain and capital flight that France had to repeal the whole thing. They admitted it was hurting the economy more than it was helping.
I saw a discussion thread on this, and that was the #1 fear, the slippery slope. First, it's billionaires. Then it's decamillionaires.
Yeah.
Then it's anyone with a nice house and a 401k that's done well.
And once you establish the legal principle that the government can tax unrealized gains, money you haven't actually made yet, there's no real barrier to just lowering the threshold. If they can do it to Larry Page, they can do it to a dentist with a successful practice.
You know, what's interesting is that even Governor Newsom seems to get this. He's been surprisingly vocal against this bill.
He has to be. I mean, he can read a spreadsheet. He knows he's competing with Texas and Florida for talent and capital. He said you can't isolate yourself from the 49 other states. He knows money is mobile. If you become hostile to it, it just leaves. It's really that simple.
Plus, the legal fight would be a nightmare. I have to assume Elon Musk's lawyers are already drafting the briefs on this?
Oh, absolutely. There are huge constitutional issues. The exit tax almost certainly violates the right to travel. You can't penalize a U.S. citizen for moving between states.
And the Commerce Clause.
That's the other one. A single state trying to tax worldwide assets. It's a jurisdictional mess.
Okay.
Can California tax a factory in Germany because the owner has a house in Malibu? It's a legal minefield.
So even if it passes, it could just be tied up in court for a decade.
Right. While the economy suffers from all the uncertainty, business hates uncertainty. If you don't know the rules, you don't invest. You go to Texas where the rules are clear.
So bringing this all home, the stated goal of AB 259 is noble, right? Fund healthcare, education, fill budget gaps.
The objective is noble, sure, but the mechanism is self-defeating. You can't fund schools and hospitals by destroying the very tax base that pays for them. If that innovation engine moves to Austin, the jobs, the support staff, the construction projects, they all go with it.
You risk hollowing out the entire state, turning California into a museum of what it used to be.
That's the real danger. It's not about feeling sorry for billionaires. It's about the health of the entire ecosystem they support. When the elephants leave, the whole landscape changes.
It brings up a really provocative thought to end on then. We talk about property rights in this country as, this fundamental pillar of our freedom. But looking at this bill, if the government can just decide your company's worth more than you can sell it for, and if they can force you to sell your controlling stake just to pay them.
Do you actually own your business?
Or are you just renting it from the state of California?
And based on this bill, the lease is up for renewal and the rent is about to go way, way up.
Something to chew on. That's it for this deep dive. Thanks for listening.